Good afternoon, everyone. My name is Brian Overby. I am the Senior Options Strategist at Options Play, and welcome to our event today called Intro to Index Options. We're going to introduce index options and take a peek at some of the ways that you want to trade, some of the advantages in general of index options, and why they are an interesting underlying to use if you're considering selling spread strategies, i.e., short call spreads, short put spreads. One of the biggest things about an index option relative to an individual stock is that, and the way I like to say it is that it has some volatility with some predictability, and that you have a fairly volatile underlying, but it is muted by the fact that it is an index, and there are a plethora of different stocks that are in that index that mute that volatility. So without further ado, I want to let you know that in the chat box, there is inside the Zoom profile, if you look down below, you will see a chat box and a Q&A box. The Q&A box has a question on it. If you'd like to put some questions in there, more than happy to address them throughout the entire event. All right, so let's get started. We've got a few disclaimers to get through. Well, to start off with, we're going to talk about what index options versus ETFs, because that is probably the biggest question that we receive all the time is what's the biggest difference? And there are quite a bit of differences between the two, and we're going to get into that. And then it comes down to European versus American. There's some huge tax benefits if you're trading in a non-retirement account to index options. We're going to look at the NASDAQ 100 index, and we'll also look at SPX and NDX. We're going to look at these different indexes to see how much different they are relative to trading the actual ETF that tracks that underlying index. All right. So to start with, let's talk about the primary differences between an index option and an ETF option. So what is an index? Well, if we look at indexes overall, what you're looking at is a basket of stocks. And that basket of stocks, if you're looking to try to hedge a portfolio by using index options, what you want is that basket of stocks to look a lot like your portfolio. So by the fact that you're going to bring in a whole bunch of stocks, put it all together in one nice little package, and then you're going to calculate a valuation that is called the index. So the method of calculation to track a basket of securities to measure the performance of a group of assets. Now, it provides performance on a broad-based index or on specific slices of the market. So you'll hear things like the semiconductor index versus the NASDAQ index or the S&P 500 index. So you do have little sectors which are considered, you have sectors versus the actual broad marketplace. So you have tight indexes that may only have a few different stocks in them, or you have the NASDAQ 100, which has over 100 different stocks that are in there. Indices are not tradable. They're only used to track performance of an asset. Now, you hear them quoted from all the time in the financial news. What is the S&P 500 index? Where is the NASDAQ at? But you cannot buy that index until ETFs came out. And when an ETF came out, that will try to track that index, and that gave you an opportunity to be able to buy something that will act a lot like the index that you like to follow. So what is the ETF? Well, an ETF, the NASDAQ is the NDX, and we're looking at the ETF. The ETF that tracks that is the QQQ. So the ETF is a basket of securities that can be bought and sold on the exchange. It's similar to a mutual fund. However, it's traded intraday. So ETFs are the new hot thing. One of the biggest headaches with mutual funds was that you could only buy it once a day. And some they have adjusted that where they have some mutual funds where you can trade them throughout the day, but the bulk of mutual funds are either bought once a day, and whatever that price is the price that you're going to get for that mutual fund. An ETF trades throughout the day. It trades on an exchange. They're usually quite liquid, especially if they trade very major indexes like the QQQ that tracks the NASDAQ. And they typically will track an index or an asset such as gold with a lower expense ratio. So one of the biggest upsides of an ETF is that they're tracking the index. There's not a ton of management that's going on. Now you'll see mutual funds that say they're based off of the S&P 500 index. Well, that mutual fund means that it has a money manager, and that money manager is buying and selling stocks and takes a little bit higher percentage because of the work that they do. When you're looking at an ETF, we're just buying the stocks, right? We're just putting the stocks inside. Whatever is in the NASDAQ is going to go into the QQQ. And so the management fees are a lot lower because it's just a very straightforward process as far as that ETF is concerned. Now, here's some of the differences on a stock versus an ETF. And these are big differences. The first one is probably the most important one to me, is that it's cash settled when we talk about indexes. That means that if you're looking at the NASDAQ 100 index and somebody exercises an option contract and you are short that contract and are assigned, you don't end up buying all 100 stocks in the index. All that happens in your account is they look at where is the strike price of your option contract and where is the index at currently. And that difference is determined as a cash settlement. And if you are down on the position, you're the one that got assigned and had it taken away, cash goes from your account to their account. Or vice versa, if you exercise an option contract because there is real value, intrinsic value, all of a sudden there is cash in your account where there used to not be cash in your account. So that is a huge benefit because you don't have to deal with buying the stock, selling the stock. All that happens is that cash trades hands in the account. So options listed by exchange directly on an index. So most indexes, well, there's a few of them are traded on one specific exchange. For example, the S&P 500 index trades on the Chicago Board Options Exchange, the CBOE, and the NASDAQ 100 index trades on the NASDAQ exchange. So these indexes trade in particular on one exchange. ETFs usually trade on all of the exchanges. They're European style, so in this day and age, there's a lot of European style and American style option contracts. And so let me talk a little bit more about American style, and I'll tell you how European style is different. Okay. So if you have an American style expiration, that means that any time from the point that an option contract is bought all the way up until that expiration date, the owner of that contract can exercise their option contract. The market can be open, the market can even be closed, but you need to get access to your brokerage firm. But ideally, you can put in an exercise notice at any point in time between the day that you purchase that option contract and the day that that option contract expires. That's called American style. Now, if you're talking about an equity, which would be a stock or an ETF, that means you're either buying or selling 100 shares of stock if you did exercise that. So for example, if you are in the SPY index, the SPY, which is the ETF that tracks the S&P 500 index, and you exercise a call option, you would be buying 100 shares of the SPX. And then you would have to sell it in order to capture a gain, or ideally get a gain on the position. That's why you would exercise it. So there's another transaction that has to take place after that exercise notice. Okay, so you can do that anytime up until that expiration date. Over here on the index side of things, first of all, if you exercise, all that happens is the difference between where the index is at and where your strike price is determines the amount of cash. But lot of index options are European style, which means they cannot be exercised early. They cannot be exercised prior to that expiration date. So that's a huge benefit if you're thinking about selling premiums, selling strategies like short call spreads, short put spreads, otherwise known as call and put vertical spreads. That's the way we talk about them inside the Options Play platform. So if your option contract gets in the money prior to the expiration date and you're in an index option, you don't have to worry about getting an exercise notice. And if you're short a put option, get put the stock and have to buy the stock at the strike price and come up with all the capital to buy the stock at the strike price. Or if you're short a call option, you'd be selling the stock. Hopefully you have it in your account. And if you don't, well, then you'd be selling it and be considered short that stock in the marketplace. European style removes that risk. It can only happen at the expiration date. Now, some index options, and they're a little bit out of favor in this day and age, will have American style expiration, meaning they can be exercised early. The biggest one that comes to mind is the good old OEX, the S&P 100 index that has been around for forever. And it was one of the first indexes that ever traded stock options. And that still has an American style expiration. There's an XEO that has an American style expiration, the evil stepchild, I guess, to the OEX. But these indexes, the fact that it's American style really makes it interesting if you like selling spreads. Now, there's also a tax advantage, and I'll get to that a little bit more. But if you are in a non-retirement account, there's something called the 60/40 rule, and I'll get into that as we go in. This show's not about tax recommendations, but I'll just show you the rule and I'll make you aware of it, because that can benefit if you're swing trading or short-term trading, these type of strategies that we're talking about. Now, in indexes too, one contract equals 100 times the index level. So that's a little bit different than the stock, so it's worth mentioning. Now, as far as the premiums are concerned, you calculate them the same way you would with an option contract. If you get a quote on an option on a stock or an ETF, you see that it's trading for $3. Multiply it by 100, you'd see it's $300. Same thing in the index world. If you saw an index option trading for $3, the multiplier is 100. So you multiply that times 100 and you come up with $3. So the exact same concept. But the reason why it's $3 in the stock and ETF world is that it represents 100 shares of stock. It's not just a multiplier. It's a 100 shares of stock. So you look at it as I'm either buying or selling 100 shares of stock. And if that option contract represents 100 shares of stock, that's going to be the multiplier to get that quote on that option contract. All right. So European versus American style. Most index options are European. That means they can only be exercised at expiration. There's cash settled, means you don't have to deal with the stock. You don't have to deal with the don't have to deal with the stock, and you don't have to deal with buying and selling the stock. It's just cash settled. They have AM settlement, which in the more popular indexes in this day and age have PM settlement. So all the little nuances in an index option that were kind of annoying to index option traders have really gone the way of equity settlement. So they typically have AM settlement. That's not 100% the case anymore. They also have PM settlement. Now here's what the difference is between the two. AM settlement means that the option contract stops trading on the Thursday before the Friday expiration. And that's the good old-fashioned SPX option contracts. They were always AM settled. That means very, very popular index. They're European style, and they would stop trading on a Thursday, and the settlement price would be determined on the opening the next morning as opposed to the closing. But now they also offer PM settlements. So all stocks at this point in time, In the American Stock Exchange, all stocks that trade on these exchanges are PM settled. The price of the option contract or the underlying stock or ETF is determined on the close on that expiration, which is usually Friday. In the index world, there's some AM and some PM. So you need to know what your settlement value is. And in particular, in the S&P 500 index, they have AM settlement and PM settlement options intermingled. And I used to be on the Chicago Board Retail Options Committee. And at one point in time, I got them to split up. Well, I requested, and it ended up happening. The whole committee decided to do this, where you used to have an SPX AM and an SPX PM. And those were the chains. You'd have the AM and the PM chains. Now they got rid of that. Those chains are gone. So you have American style and European style index options inside the same chain. So make sure you're aware, because the day they stop trading is much difference between the two. So don't let this scare you, right? Just don't, just know that it is a thing, and that if you're going to be trading in the very popular indexes, that you want to make sure that you know if that option that you're actually buying or selling has AM or PM settlement. Okay, so in the SPX, they put a W next to the weeklies, SPX W, and those are PM settlements. If it just says SPX, well, then that option contract is usually an AM settlement option contract. All right. Any questions on that? Because that's a deep concept that does matter. So once a month in the SPX, you're going to run into that AM settlement Friday expiration. All the daily option contracts are PM settlement, which kind of makes sense because they trade for one day. You got a Monday expiration, a Tuesday expiration, Wednesday expiration. So if you think about that. So that's one of the other benefits of index options, is the fact that they usually have daily expirations, and the ETFs that track them usually have daily expirations. So the QQQ, the SPY, there are a plethora of different expirations that you can trade, and that's not usually the case in most individual stock options like Apple, Google, any of the Mag 7s. Those stock options do not have zero DTE options, or options that expire day in and day out. Okay, so here is the index options, and here is the section 1256 contract, but here's what the tax benefit is on index options. And once again, we're not a tax advisor, so please talk with your tax advisor. But if you are in a non-retirement account and you are trading index options and you have a capital gain, it is marked at 60% long-term and 40% short-term. So you get a benefit of the long-term capital gain, which is a lower rate relative to the short-term capital gains. So that's a huge benefit if you are trading capital in that is not inside a retirement account, and that has ideally a will be responsible for taxes. Now, most brokerage firms will allow you to trade some index options in retirement accounts, but you have to get approval to be able to do that. So just keep that in mind. Once you get that approval, almost all the strategies that I'd show you today will be doable inside a retirement account as long as the risk is defined. I don't want to talk much more about taxes. Now, it's regardless of the holding period, in that it doesn't matter if it's a short-term, long-term, whatever. It's the 60-40 rule overall, and it's marked to market at the end of each year for tax purposes. So they go to the very end of the year to mark where they are at, and then if you're in that position, it's either a long-term or short-term capital gain or loss based off of where that market ended at the end of the year. Now, on ETF options, they're the same as stock. There's not any different. Your cost basis is what's in the stock. As far as option contracts are concerned, it's if you bought it and sold it, if it's a short-term capital gain, it's a short-term capital gain, and positions held for less than a year. Now, these can change once again, so please check with your tax advisor based off of those ETF options and the tax benefits. All right, so now these are the benefits or the perceived benefits that we have on index options. They are European style, which means that they do not get exercised early. So in particular in strategies where you're selling, bringing in a net credit, that can be a benefit. They are cash settlement. In other words, you don't have to worry about buying and selling the stock and coming up with all the capital to buy and sell the stock. Listed on some of the most liquid and widely tracked indices. So it diversifies from that single stock risk. And the best way that I've always came up with saying this is that indexes will give you some probability with some volatility with some predictability. Easy for me to say. Some volatility with some predictability. And the reason why I say that there's some predictability is that if you're trading individual stocks, the hardest thing to manage in the option trading world is gap openings and gaps after the market closes, right? The market closes, news hits, the market gaps down, the market opens and there's prior news or there's an earnings report and the market gaps up. In the index options, it will affect that index if that stock is in the index, but it's much more muted because there are a lot of other stocks and some other stocks may have gone down while that one stock is going up. Okay, there are about 50 indices in the US that have index options. Contract sizes are typically more suitable for institutional than retail. Well, that's not always the case. Let's put it this way. If you're looking at just even an underlying stock, here's one of the things about index options relative to ETFs. For example, the S&P 500 index is a $5,000, well, almost a $6,000 index at this point in time, where the SPY is going to be a $600 index. The more expensive the underlying, the more expensive the option contracts are going to be. So if you want to do math, it's not ideal, not perfect, but if you look at the price of an at-the-money 30-day index option in the SPX, it's going to be about 10 times the value of an at-the-money 30-day SPY option. And it's mainly because the value of the SPY has been reduced to make it more suitable to be able to buy 100 shares of it. So because of that, the price of expensive index options will be higher. So that's where this comes from, that they're typically in that range. So at this point in time, if you have any questions, please do put them in the Q&A box. And if that is said, let me do something here. And I'm going to jump over to the Options Pro. We're going to run over to the Options Playbook, and we're going to look at a couple of index options on some of the indexes that track the NASDAQ. There's quite a few of them that are out there that are available inside the software. We're looking to add the S&P 500 index. There's no guarantees at this point in time, but you do have access to those type of option contracts inside your brokerage platform at First Trade. And we'll just look at some of the strategies and how I'd like to approach and just even think about selling options on indexes. So here we go. Okay, so if I'm looking at the SPY, for example, and you're selling the SPX versus the SPY. The SPY is a $596 point underlying stock, and if I want to do a volatility trade, something where I'm trying to sell an option contract versus owning that underlying outright. So I'm going to sell a put spread to get bullish on the SPY. We would consider that in the high implied volatility situation. And here we have the bear put spread, and we have the bullish put spread and the bear call spread. So in this instance, if I'm looking at this trade, one of the things that we like to highlight is that we're going to sell something that brings in some solid premium. In this instance, the software selected the 596 strike put, and we're going to go fairly wide and bring in a decent net credit to the account of $5.89. So if we look at the trade here, we have a solid risk reward. If the market stays where it's at or it continues on up, we're bringing in $5.93, and our reward would be $589 per 1x1 spread that we put on. And the risk would be the difference between the strikes minus that $589, or $1,611. Now, relative to that would be the S&P 500 index, and we haven't added that symbol yet, so I can't really look at it. And I think because of that, my NASDAQ symbol is not coming up at this point in time. But we do have access to some of these. So I'm going to have to ride with the SPY. So let's do it this way. And I see we have a couple of questions. Would it be better to use SPX or SPY on spreads like Iron Condor? From Mario. I would rather do an SPX Iron Condor, and let me pull up my book. I'll pull up the options playbook here. Let me get this up and running over on this screen, and let's talk about those two strategies, all right? And I would rather do it in the SPX, but the issue is that it is a much larger contract. So there's going to be, you're going to have a wider spread. And instead of being able to do 10 by 10 Iron Condor, you're going to probably only do one, right? In the SPY, you would be looking at 10 contracts to get the same amount of premium and type of risk that you would have in the S&P 500 index. So I'll pull up an Iron Condor and we'll look at that. So the Iron Condor is essentially two different spreads, right? We're selling the short put spread and we're selling the short call spread. We're doing this for a net credit to the account, but one of the biggest benefits of an Iron Condor is that the market can only go in one direction, right? The market either has to go up or go down by the expiration date. It can't do both. So you get some margin relief in that whatever one of the spreads is all that has to be taken out. And that's what we say right here. The margin requirement is the short call spread or the short put spread, whichever is greater. If they are the same width apart, then it doesn't matter, right? It doesn't matter if you're looking at the call side or the put side of things. So if I'm doing an Iron Condor, one of the biggest things that is really nice about it compared to the SPY is that what happens if the stock finishes in between these strikes? Let's say the market comes up this direction, you brought in a hefty premium on it, but you're now at expiration. And if you have the SPY and you have the strike C, which is a sold call option, now you got to do something, right? Because you're going to get that stock called away from you. And if you are between the strikes, this is a fairly big headache that can happen if you trade the SPY versus the SPX. Also on the put side of things, if we land somewhere in the middle, you are short a put at strike B. So if it lands somewhere in the middle, you could be put that stock. If we're in an index, you would be down, you could be down on the position, but all that happens is cash would get taken away from you. You wouldn't have to deal with buying and selling the stock to get out of that position. So that's a huge benefit of the indexes, but as mentioned, they're going to be a little bit more pricey than the SPY. All right, I will add the screen share. Everybody seeing my screen just fine? And then Kevin asks about the SPX versus the SPY and liquidity. Let me make sure. Everybody seeing my screens just fine, right? No, we're not. Okay. Now we're sharing. Thank you for that. So in this instance, if we're doing this, the Iron Condor from strike B to strike A, if we land somewhere in the middle here and we're in the SPY or the QQQ, that's a concern. If we land somewhere in the middle here between strike 3 and strike D and we're in the SPY, you have to do something with the stock. In the indexes, it's cash settled, so that's a huge benefit. And that's also the case when you're looking at, let's look at just a short put spread, right? So that's the same scenario here, but on a smaller basis. If you land somewhere in between here, I recently did a seminar for First Trade called Landmines, and that's one of the landmines. If you fall asleep and you are short this put at strike B and the stock lands right in between here, you might get put that stock. And if you get put the stock, you got to buy it. And that also means you got to sell it. And you have to have the capital to buy it. So there's you don't want to fall asleep. You want to close out those positions if you're in a stock or an ETF somewhere in that range. Thank you, Anonymous. All right, so let me go back and take a peek inside the software. I think part of our issue right now is that we're looking to try to add some indexes, and we're going to have to just focus on the SPY. Let's focus on the SPY and the QQQ, okay? So we'll go look at the QQQ. And the QQQ will have a little bit more volatility in it. And here's the ETF that tracks the NASDAQ. And if you want high implied volatility trades, once again, here is the short put spread that we would look to execute. We click trade. It shows you your risk versus your reward. July 18th expiration. So we're going out 44 days. And so let's talk a little bit about time premium. And I know it's the trend to try to sell short-term option contracts and do the 0 DTE options. And index options offer it, and big ETFs like the QQQ will offer those shorter term expirations. But the reward is very quick and it comes to you fast, but the risk is also very quick and it goes against you really fast. And we've actually done some math on it, and it's about 10 times the movement of a longer term option contract. So if you're doing index options in particular, we also kind of look at about a 44-day or 45-day period on stocks, because time premium is your friend. Time premium can help you if the market goes against you, but it slows down your profit if you are up. But if I look at these type of trades, and I'm going to continue to do QQQs, I'm going to continue to do SPY, I'm going to do these ETFs or these indexes, looking at a longer dated option contract makes a lot of sense in the indexes when you're selling these type of trades, mainly because earnings are going to be muted, right? If I'm looking at a single price stock, Broadcom is going to be announcing earnings after the close tomorrow. There's a lot of single stock price risk in AVGO. Semiconductor stock trading at about 150% implied volatility. I wouldn't necessarily want to do a longer term trade, especially around earnings. I want to give myself a little bit of time, but going out 44 days, I would probably just avoid that earnings. But I don't mind going in and looking at the QQQ, which Broadcom, I'm pretty sure is a stock that's in the QQQ. But I'd rather trade this and look at going out about 44 days. Now, we're going to apply some rules to doing these short spreads, and I'm going to go back to my slides and I'll show you that. But in general, this gives you some time to adjust the trade. So the platform is going to pick out those type of trades. So if we go out, say you're bullish on the QQQ or the NDX, and we sell a put spread against it, the platform is going to decide, you can adjust this, but in general, the default's going to be about 44 days out. And the rules and the alerts inside that platform are going to help you decide when to get in and get out. So if you want to, you can create a portfolio, and we'll call this ETF spread. And you hit create. And then you can take this trade and you can add this position on the QQQs into your portfolio of stocks. And now if we go over and check out our portfolios, it will show you the ETF spread that we put on. Let's get rid of that one, put that one on. And it will track your profit and loss on the QQQs, on the portfolio for the short put spread. It'll put your cost basis in, show you where the market is at, and it will show you your position throughout time and track it. Then it also will allow you to adjust the trade. So if you click on this, it will say this is where our current trade is at. This is our profit and loss. We can close the position. If we click close and trade, it will show you the closing trade. Or we can adjust the position and roll it if we would like to, or just roll and modify just one of the trades. So for example, if we wanted to roll one part of this option contract, say time has gone by and the market has gone down, one of the things I like to do in these type of trades is roll my short option down. So for example, in here we paid $6.53 on our put spread. Let's see, that we sold the 528s for, we paid $12.90, right? So we'd have to buy that back, and here's a roll. Here's a roll that I'd like to do. Okay, we have our, this is protecting us. So let me show you an adjustment to the trade, and we do this inside our daily play positions sometimes, portfolios that we'll manage. And here's the roll position. Let's say let's go back and trade this again. Let's say that the market has gone down, and in this scenario, or the market has started to go up, and in this scenario, our short option contract is starting to decrease in price, right? We have our protection in, we have that short option contract. One thing that we can do is take this position and we'll buy to close this, and we'll actually sell another option contract that will go up in strike and bring in a little bit more premium. So if the market's at 528, we're going to go up and possibly buy to close that option contract, and then sell to open. Let's do, we'll do a we'll make it simple, 530, 534 option contract. And you click trade. What it will do is we're buying to close our short option contract, the 528 strike, and then selling to open the 534 strike, bringing in a net credit of $2.62. So sometimes I will roll a strike up to try to bring in a little bit more premium and leave our protection there. Now, there will be an increase in the margin requirement to do that, but if this becomes low enough that I want to get a little bit more premium within the trade, that's one adjustment that you can make on the trade. You can also roll it down, and the options play portfolio will allow you to do that easily within your paper trade portfolio. So if we hit add position, it will do that. And then it will adjust your trade, and it will show you now you are short the 534 strike put, and that was done at a cost basis of $16.52. And so we were able to bring in more premium for that option contract. So it's keeping track of that along the way. And I see we have quite a few more questions that are popping up. How many index options realistically have enough liquidity to trade effectively other than the SPX? Bruce, I would say 5 or 6 major indexes that can do it. Now, there's one other index that will trade from time to time, and that's the VIX index. The VIX index, if you trade the monthly option contracts, they're fairly liquid, but you obviously have the NASDAQ, you have the SPX, and the SPX is by far the most popular out of the indexes. The NASDAQ is also very popular. And then, you have the Russell 2000 index, which isn't available on all platforms, but the IWM is a very liquid underlying that trades based off of that index. So there are about 4 or 5 indexes that are really liquid enough to be able to trade. There are a few in the sectors, but if I'm looking at a sector, I think I'd rather trade the ETF if you can. So you make a valid point, Bruce, that there aren't a lot of them that have enough liquidity to make it feasible to trade it. But I personally trade the SPX quite a bit, and the NASDAQ and the NDX. Those are the 2 that I like to use. Does SPX have any commissions or any other exchange and regulatory at First Trade? I don't know that answer at First Trade, but sometimes there's additional fees to trade the S&P 500 index, and those fees are passed along from the Chicago Board Option Exchange. And in particular in the SPX, that's where that is coming from. So there sometimes are additional fees, but I am not a representative of First Trade. All right, do we have any other questions? Okay, so Kevin asked about the liquidity in the SPX versus the SPY. Okay, Kevin, so here's a valid point. Here's a valid point when we talk about it, and I wanted to address this earlier. But if I'm looking at the SPX versus the SPY, realize that it is 10 times the value. So if you have a $1 spread in the SPY, you would have a $10 spread in the SPX, right? So 1 point represents 10 points in the SPX. So you're going to have a little bit wider markets. There's much more play involved in the SPX, but you also have a much higher valuation. And if you've ever noticed, even on expensive underlying stocks, a lot of times the more expensive the underlying, the wider the bid-ask spread will be on the stocks. Not necessarily because they're illiquid, it's just that that's a method, or it's a situation that is created by the price of the underlying that those option contracts trade on. I personally in the SPX, I usually will trade, very rarely buy an option outright. Just buy a call in the SPX or just buy a put in the SPX. I'm usually doing spreads, and if you do spreads, a lot of times you can feel close to the midpoint where you give them a buy and you give them a sell. So it's easier to trade the SPY because it's a smaller contract, and in general, the bid-ask spreads represent less money and it's very liquid. But in the SPX, you have to work the orders a little bit more, but there's the huge benefits of the fact that they are cash settled and you cannot be exercised early if you're trading a European style index. All right, I see a few more questions that have popped up. I'll address those. Oh, I think we're good. So at this point in time, go back here. And if you have any other questions, put them in. If not, we'll be back in a couple of weeks' time to talk more. But index options, here's the thing about index options is if you take the time to learn them, there are a lot of benefits that go along with trading index options. You got to deal with a little bit wider bid-ask spreads most of the time, but the headache of not having to deal with buying and selling the stock in the cash settlement is a large benefit in my mind to index options, and it's part of the reasons why I like to trade them so much, is that they just come and settle in cash. And so all it is the difference between the strikes and where that cash settlement is at. Now, the website that I showed you with the Iron Condors is my website. It's optionsplaybook.com. The site that we did all the research on is optionsplay.com. My handle is @BrianOverby if you want to follow me on x.com. And if you have any questions, feel free to answer a few more that are here. All right, and I don't see any more questions coming in. So I do appreciate your time today. Thanks for stopping in and checking out the Options Play education sponsored by First Trade. And make sure you get your questions together. If you have any requests or anything that you would like to see as far as option trading is concerned, let us know and we'll try to address it. And thanks for stopping in, and we'll see you in 2 weeks' time for the next education session here at First Trade Securities.